Hello, everyone. Welcome back to the Big Economist channel. Today, we've got an in-depth discussion coming your way about the recent happenings and developments in the car market. Before diving in, though, there are a few key points and context I'd like to set. Now, I apologize for the slight delay in getting this update out to you all. My schedule over the past week has been jam-packed, which caused this minor delay. But as they say, better late than never. One of the significant pieces of news that I couldn't wait to share is about the Federal Reserve's recent meeting. The institution has again decided to raise the federal funds rate, this time by an additional 25 basis points. This adjustment brings the federal funds rate to a range of 5.25 to 5.5%. To put things into perspective, this is nearly double what is conventionally deemed as a neutral federal funds rate. For those unfamiliar with the term, a neutral rate is believed to be a rate that neither stimulates nor restricts economic growth. Now let's talk about the ripple effects of this decision, especially in the context of the automobile sector. According to the renowned industry analyst Cox, this interest rate hike has led to a significant change in the car buyer demographics. We're seeing a reduction of around 5 to 10% in the potential car buyer base. What this essentially means is that the increased interest rates have deterred 5–10% of prospective car buyers from making a purchase. The situation is more pronounced in the used car sector compared to the new car market. As a result of these changing dynamics and the reduced buying capacity, there's been a noticeable dip in used car retail values. Current figures indicate a decline of about 3%. The wholesale car segment hasn't been spared either. In fact, the drop there is even steeper, clocking in at over 10%. However, it's not all gloom and doom. There's a silver lining that we can look forward to. Recent trends suggest that the used car market might be heading towards stabilization in the foreseeable future. While rates had previously reached a peak in March, with the average used car rate hitting 14%, recent statistics show a slight reprieve with rates currently hovering around 13.6%. Yes, this is still on the higher side, but the encouraging sign here is the plateauing trend, indicating no further spikes for the time being. Transitioning from the used car market, it's pivotal we shed light on the new car market and its evolving dynamics. Interest rates play a vital role in shaping buyers' decisions, and with the current trend, it's something we can't ignore. Recent statistics reveal that interest rates for new cars have witnessed an uptick, now standing at an average of 9.2%. This figure might surprise many, especially considering the seemingly attractive rates touted by certain automakers. Brands frequently market lower interest rates, like 1.99 or 2.99%, as promotional offers to entice buyers. However, the reality paints a different picture when a buyer seeks financing through traditional avenues like banks or credit unions. There, one is most likely to encounter rates that hover close to the 10% mark for new cars. So, what does this mean for the overall new car market? Cox, the industry analyst we mentioned earlier, raises a flag of caution. They opine that these soaring rates could potentially suppress the enthusiasm of potential buyers. High interest rates tend to act as deterrents, making consumers more hesitant about committing to a new car purchase. However, the current scenario seems paradoxical. Despite the relatively high interest rates, there hasn't been a significant pullback from purchasing new cars. In fact, forecasts suggest that the new car market is poised to register more sales this year compared to the previous year. This situation sets the stage for a fascinating interplay between buyers' aspirations and financial prudence. Will the escalating interest rates eventually weigh down on the new car sales? Or will the allure of owning a new vehicle override these financial considerations? Diving into my personal perspective on this intriguing situation, I believe that while the automotive market is undoubtedly experiencing flux due to the rate changes, it's also a testament to the resilience and adaptability of both manufacturers and consumers. The automotive industry has historically demonstrated an uncanny ability to adapt to shifting economic landscapes. However, it's also prudent for potential buyers to be cognizant of the financial implications. High interest rates, if unchecked, could translate to substantially higher costs over the tenure of a car loan. While the immediate future of the new car market appears promising, It's this delicate balance between desire and feasibility that will dictate its trajectory in the long run. Diving deeper into the dynamics of the used car market, several crucial aspects come to the forefront which seem to shape consumer behavior and market trends. Firstly, discussing the used car market, it's not solely the pricing or rates that are influencing buying decisions. While I have previously touched upon this on my channel, it's essential to reiterate the point. Many of the cars that end up being sent to auctions are in far from ideal conditions. These vehicles, often perceived as low quality or junk, contribute significantly to the negative perception of the used car market. Naturally, prospective buyers would be wary of investing in vehicles that might pose long-term reliability issues or require immediate repairs. These inferior quality cars, unfortunately, make up a sizable segment of the used car inventory, reducing the overall attractiveness of the market. However, on the opposite end of the spectrum, cars that are in pristine condition, ones that have been well maintained and are more desirable models, are fetching premium prices. These top-tier used cars often go for substantial amounts, making them largely inaccessible to the average buyer. This bifurcation effectively means that unless a buyer is relatively affluent, their options in the used car market are limited to less desirable vehicles. This dichotomy in the used car market is expected to persist. While some cars, depending on their make, model, and condition, will experience significant depreciations in their values, others, particularly those in mint condition and of more sought-after models, will continue to command high prices. Such trends are not new, but rather intrinsic to the nature of the used car market, where the value of a vehicle is assessed not just by its age, but by its condition, model, and demand. Additionally, industry insights, such as those from Cox Automotive, suggest that the used car market's future is likely to be stable. They predict that while there might be periodic fluctuations in prices and demand, the overall market will maintain its current trajectory. Drawing from my observations and understanding of the market, I find myself in agreement with this assessment. Despite the challenges and disparities that exist, the used car market is robust, driven by a range of factors, from economic conditions to consumer preferences. Analyzing the new car market presents a more intricate landscape than the used car market. As the global demand for new cars becomes increasingly satisfied, various dynamics come into play, influencing both the supply and pricing of vehicles. To understand the broader picture, one should look at the day supply metric, which essentially denotes how many days it would take for a company to sell all of its current inventory at the present sales rate. Over the past year, this number has been gradually increasing, indicating that manufacturers are getting closer to meeting the demand. This equilibrium, however, is on the cusp of being disrupted. Companies like Toyota, which were initially hit hard by supply constraints during the pandemic, are now in a position to build and provide more cars. Instead of artificially curbing their production, a strategy adopted by some like GM to maintain a certain pricing power and profit margin, Toyota is gearing up to produce vehicles at full throttle. The strategy behind GM's decision, in simple terms, was to restrict supply, creating a scarcity that could justify higher prices. It was essentially an exercise in leveraging supply-demand dynamics for improved profitability. This was quite evident over the past half year, hinting at a paradigm shift where automakers prioritize profitability over sheer volume sales. However, Toyota's aggressive production approach is bound to challenge this strategy. If companies like Toyota and Tesla, known for their robust production capabilities and market presence, continue to churn out cars in large volumes, it threatens to erode the market share of those automakers who are holding back. Such a scenario would likely force these automakers to rethink their strategies. Faced with declining market shares, they might pivot to ramp up their production capacities, ensuring they're not left behind in the race. Such a change will have cascading effects. A surge in vehicle availability will likely bring about more competitive pricing, resulting in more significant discounts and benefits for the consumers. Predicting an exact timeline for these shifts is challenging, but a ballpark estimate suggests that within the next 6 to 18 months, The new car market will undergo substantial changes, characterized by increased availability and more attractive pricing structures. These are certainly exciting times for both the industry and consumers. Stay tuned for more in-depth discussions and breakdowns on this topic in future content. See you then.